All right, all you wealth builders out there, welcome back to part two of our sit down with Marcus Crigler. Today, we're going to be diving into the exciting world of bonus depreciation. Yep, you hear that right, exciting world. Picture this: you buy a property, and instead of just sitting back and waiting for it to appreciate like watching a tree grow, you get to write off a chunk of its value right away, giving you that sugar high today. Put the time in, get real estate designation, grab your calculators, because by the end of this episode, you'll be ready to turn tax codes into cash flow. So let's jump right in. Part two, Marcus Crigler. Okay, Marcus, thanks again for joining us. Marcus, for real estate professionals, tell me, this is a word that gets bandied around all over town. People don't know it. They don't understand it. They don't know how it works. It's some mythical pay no tax thing. For most people, let's demystify it right now. For real estate professionals, how exactly does bonus appreciation or depreciation work to shelter income, Marcus? You're the grandmaster of this conversation.
Yeah, let's just take it from the very beginning, right? It's you got to be buying real estate, right? You have to be buying and holding real estate. If you are buying and selling consistently, there's no benefit, right?
Yeah.
So we're talking about buying and holding real estate and really the benefits that you get. This is what's so sexy about depreciation. And you had a little Freudian slip there and you said appreciation, but it's because you're depreciating an appreciating asset. Right. And so that's the little loophole, right? That's why everybody loves it, because what you can do is you can go out, you can buy an asset, you can do what's called cost segregation. You can combine that with what the current rules are for bonus depreciation. We can get that into that a little later. And you can take accelerated depreciation on an appreciating asset, take losses on paper that you can utilize against your other income that you're making. Only real estate professionals can do that, right? If you are not a real estate professional, you don't get to take those losses against your other income. You can only take those losses up to your current income. And there's certainly some exceptions to that, but from a general rule, that's what we would be focused on.
So, Marcus, two things that pop up immediately in my head is number one, I'm listening to this. I buy real estate. I have a rental property. I flipped a house like 2 years ago. Am I a real estate professional? And then the next thing is that, let's say that I am a real estate professional. I hear it all the time. Yeah, I'm going to do a cost segregation, bonus depreciation. Those terms are used interchangeably a lot. And I think most people kind of understand, but it's just like our previous episode we did with you on the self-directed, is I think they understand about 30%. They understand just enough to be able to have a discussion about it. But the minute that someone says, tell me more about that thing you just said about cost appreciation, they're done, right? Talk to us about what is a real estate professional. And then if they are a real estate professional, walk us through maybe an example of how you integrate cost segregation into bonus depreciation so they can go and potentially do that on a candidate of an investment they have.
Sure. So what is a real estate professional? First off, if you don't know if you are one, you aren't. That's pretty much, you can pretty much assume that, right? So a real estate professional, you are somebody, as technically defined, you're spending 750 hours or more in real estate related activities, and there's a list of what those are. Plus, it has to be over 50% of your working hours, right? And so generally, if you are a full-time W-2 employee, you're not going to qualify unless that full-time W-2 employee is under one of those, real estate professional professions, right? And so that is what a real estate professional is. If you have a question of whether you are or you aren't, you're most likely not. And if you do have a question, if it's on the border, then you are definitely documenting that and making sure that you are having the 750 hours and that over 50% of your working time is in real estate, right? So that's that answer. Let's talk about cost seg, right? And you're right. People use cost seg and bonus depreciation interchangeably. They're actually two completely different things that just happen to work together, right? So cost segregation is let's just use an example of this. I think this is a better way to understand it. Let's say you go buy a house for $100,000. Usually, what you have to do to what they call put the asset on the books, if you've ever heard that, right? We're putting the asset on your tax return and basically letting the IRS know that you own this asset and you're renting this asset out. That's what we have to do. It's one of the disclosures we have to provide. What we do as an accountant is we have to separate that between building and land. And there's several ways of doing that, but let's keep it simple, and you have to separate it between building and land. And let's say about 20% of it is land, the other 80% is building. So $80,000 in the building, right? Well, what the IRS says is that building is going to get depreciated over 27 and a half years, right? That's actually great news. That's not terrible. Love that. We've got an appreciating asset. We're going to be able to write this thing off over the next 30 years. In the next 30 years, this thing is going to be probably triple what it's worth today, quadruple what it's worth today, and we'll be writing it off the whole time. So that's actually not a bad deal. That's just depreciation. But what the cost seg does is it takes that building and it takes an engineer study. What a lot of people don't understand is that cost segregation comes from an engineer. And the engineer comes in and says, okay, well, this building is actually broken down into multiple pieces and parts, right? It's got countertops, it's got light fixtures, it's got flooring, it's got plumbing, it's got land improvements, it's got all these things that actually are depreciated over a 5-year life, a 7-year life, a 15-year life. And so the cost segregation is simply to come in and say, hey, I love 27 and a half, but I could get it even better, and I can get some of these pieces to be written off over 15 years, and I can get some of these pieces to be written off over 5 years. And we've done that for years. This has been a massive part of depreciation for forever. But what happened and what really spurred the conversation about cost segregation was when the Tax Cuts and Jobs Act allowed for 100% bonus depreciation. Well, 100% bonus depreciation said that any of those 5 and 15-year lived assets that cost segregation, that engineer study broke out, we could write 100% of it off in the first year, right? Well, as we talked about as a real estate professional, that particular, we usually see 20 to 30% of a building's basis, right? That $80,000 in first year write-off, or that's what we used to see. Now, since then, I'm going to take it a little deeper. Since then, the laws have changed, and we've got last year it was 80% bonus depreciation, which means of that 5 and 15-year lived assets that we just talked about, we can only write off 80% of that last year. In 2024, it's 60%. In 2025, it's going to be 40%, right? And so that's going to decrease as we move forward unless there is a change in the tax law, which I would expect there to be one way or another. We'll just see if this part gets changed or not.
That is the biggest conversation that I'm hearing in the real estate world. If anybody thinks that real real estate investors are all that worried about the market or prices going up or prices going down, it's not what real estate professionals are sweating about. What they're sweating about is, will they reenact 100% bonus depreciation or not? With that being said, what are your sentinels telling you? Are there any recent changes to tax laws or upcoming legislation that the real estate investors should be aware of?
Yeah, there's not. I mean, we thought we might have a change this year. Never happened. We waited. Ultimately, the bill just didn't get through. And so I would expect, no matter who the president is, to be quite honest with you, I would expect there to be changes in tax policy and changes in regards to depreciation. What the last bill that was, it was through Biden's administration, reenacted a 100% bonus depreciation, right? A lot of people are, focus and say, oh, well, Trump gets elected and it'll be 100% depreciation, 100%, or if Kamala gets elected, it won't be. I don't know if that's necessarily true. I do expect there to be some changes If you go back to even when Obama it was his administration, he had 50% bonus depreciation in effect, which, by the way, is still not a bad deal, right? A lot of people look at this and say, oh, we don't get 100% depreciation anymore. Well, I was doing cost seg and bonus depreciation back when it was before the Tax Cuts and Jobs Act and before it was 100% bonus depreciation. So there's still benefits here for those real estate professionals. And here's the other thing, guys. It's not a use it or you lose it, right? We're going to get those benefits every year. So it still makes sense. And for your passive investors, those ones that maybe can't take those losses, it still may make sense for you to do a cost segregation, even though you may not you have an option not to take bonus depreciation if you don't want to. And you could depreciate, the lower lived assets over 5 years,
right,
and 15 and 27 and a half. And you just get, maybe as rents go up, you're getting more cash flow. It's sheltering more of the income from the rental more than just the, sheltering other income, right? So again, that's about getting with your tax professional and seeing if that's a strategy that might make sense to deploy.
You kind of answered my question that I was about to ask. I want to give you an example is that interest rates shot to the ceiling, right? I've got loans at 8%, 7.8%, right? And they make me cry every time I get my mortgage statement every month and the amount of principal, which is like laughable, that's getting paid down, right? And so we're especially if people are in my position where they're paying 7%, 8%, you're kind of like, when do I want to refinance that property? But at the same time, like going from a 7.7 to a 6.9, yeah, you've got mortgage brokers that are banging on your door saying, oh, it's time to refinance, rates are lower. But then you start looking at all the junk fees and all the things that are rolled into that to get into another 30-year loan. And it's like there's a tipping point as to when it makes sense for me to actually refinance. Until that point, I'd almost rather just set it and forget it. So then I asked myself the same question on the cost seg, right? Because cost segs aren't free, right? It costs money and a little bit of time and effort, kind of some of those things that you talked about on the last episode. Do you kind of have anything in your mind as a tipping point where it's like, okay, it's this year, it's 60%, next year it's 40%, or, you had just mentioned, well, even if you get no bonus depreciation, maybe it's a good thing to do because you can pull forward some of those things that are in 5 year. Do you have any kind of general rule of thumb? Is it case by case? It's just looking at someone that has real estate rental properties. Maybe they are a real estate professional, but bonus depreciation is higher, it's lower, depending on what year. Do you have any kind of tipping point in mind?
Yeah. So I think I can answer that question with this answer. It all depends on how much money they make, right? And so the more value of the cost seg, the more ROI, the higher your tax rate. And so what we are typically looking at, what most people don't realize is there's a massive gap in tax rates between, and it's about $400,000 to $500,000, married, filing joint. I think, don't quote me on it, but basically the tax rate goes from 24% to 32%. And so when we're looking at strategy, what we want to do is get everything out of those 30% brackets, right? The 37 to 35 to 32. And if you've got, money that you're getting charged at the 24% bracket, then, most people can kind of deal with that without having to, break the bank, especially if they know that next year I'm going to be making more money and I'm still got more deductions that I need next year because, I'm going to have a higher tax bracket next year, right? And 37%, maybe I'm not going to be able to buy as many rentals because of X, Y, and Z, whatever the story is. But, it all comes back down to what makes sense for you. Some of our clients come in, they're like, I don't want to pay taxes, 0%, none. Some I'm like, hey, and I'm a big fan of zero taxes isn't always necessarily a good thing, right? You can get there, and some people it makes a lot of sense for, but others that are consistently high earners, and we've got to really strategize with their deductions and when we can take them and when we should and when we shouldn't. Because again, I would rather pay 20% over 2 years than 37%, or 43%
Right.
1 year and, 10% another, right? So we just try and level it out, make sure that we've got good deductions, try and keep our clients in the teens, right? If we keep them in the teens, we feel pretty strong about that. Because again, if we invest into something that's going to give us tax savings, we're only going to get 10 cents on the dollar of return there versus when it's a higher rate, when it's 37 or 42%, you're getting 42 cents on the dollar, better ROI.
And I want you just use the word when we invest in assets that are going to help our tax rate at the end of the year. And that really sums up why you have conversations with a lot of your clients in that, like, September, October time when like, okay, guys, this is what I'm seeing, this is what's happening. And to those of you out there listening that think there's some kind of magical way of paying no taxes, it's not, you're not paying no taxes. There is a huge cost to buying assets that are tax deductible. And so, if you're trying to offset, I'm going to choose a random number, $500,000 of taxes, well, you're going to have to buy several $1 million worth of real estate to offset those taxes. And so the irony is as I look across, and I'm sure as you look across all of your, your clients, Marcus, real estate people in general really do most of their aggressive acquisitions for this strategy, but it costs an awful lot of money to do so, right? And so beyond depreciation then, right? So I know myself that, a lot of my personal portfolio was bought for and derived through conversations about tax strategy, okay? But beyond depreciation, are there some other creative legal tax strategies that savvy real estate investors are using to minimize their tax burdens? Is there anything else beyond bonus depreciation? Is there anything else beyond cost segs that, in your world, because you specialize with real estate professionals, is there other tools in the toolbox?
Yeah, completely. So, first off, most of the real estate professionals we're dealing with, they're AKA real estate entrepreneurs, right? And so we are really focusing on maximizing their deductions, right? First and foremost, are they writing off everything they should be writing off? And by the way, if you are a W-2 employee, you can go start you a little side business. And that can gain a little bit of money. Maybe it's a management company of your assets. Maybe it's something there, but you can start writing off some of your cell phone bills, some of your things that you've always had, but now you're a real estate investor and you've got some real estate activity. Now you've got some ability to deduct some of these things. Your home office expense might be a nice one to be able to deduct as a real estate investor, right? So there could be some deductions we look at. But also, let's say you can't do any of that. Let's say, man, I'm bummed out. I cannot. I'm a W-2 person. I want to get in real estate, but I can't. They're saying I can't benefit from it. So maybe I don't want to get into real estate. Don't forget about the old 1031 exchange, right? So the old 1031 exchange says that, hey, I buy this piece of real estate. And let's say I'm that passive investor. You can take advantage of this as a passive investor. You buy that real estate and that you take the long-term bonus depreciation or long-term depreciation and you just write off your depreciation as it's cash flowing and maybe you don't ever pay taxes on it. And then in 5 years from now, that asset has, I don't know, give me a number. What do you think it has increased in 5 years from now, David?
Let's say 10% a year.
Yeah, so 50% it's increased in value. Take that asset, you do a 1031 exchange. You defer all the taxes. You don't have any taxes on that exchange. You buy a bigger asset. You've got equity in that asset. You've had principal pay down of that asset. And now maybe you bought a $500,000 asset that now you're able to move up into a $1.5 million asset. Well, let me show you the math on this. If it goes up by 10% a year at $500,000, if it goes up at 10% a year at $1.5 million, which one goes up faster? One's going up 150 grand a year, the other one's going up 50 grand a year, right?
Yep.
So just through that, you're getting massive tax deferred appreciation that, by the way, you can now take loans against. And you can get tax-free money that way. And so just being a passive investor is not a negative thing. You can do this. You can buy real estate and you can take advantage of it. You just might have to play the longer term game, and that's okay.
I love that you said that, and we beat on about it ad nauseum on this podcast about buying high quality assets, right? And so I look back at my career, and I started off buying $40,000, $50,000 houses back in, 2012, 2013, 2017, whenever it was, right? And I kind of beat my chest. I'm like, oh, Marcus, I just got this asset for 40 grand. I'm going to get $800 a month rent, right? And everyone talks about cash flow, cash flow, cash flow. It's that like the number one, two, three, and fourth thing that most, especially newer investors, get into when they're buying a rental property. And then I'm like, okay, I heard about this thing called depreciation and bonus depreciation, and I'm like, well, what am I bonus depreciating on a $40,000 asset that I bought? Let's see, I take 80% of that for for the building, and then I'm like, there's no tax benefits on buying some crappy property out 45 minutes outside of your nearest city. And so it's like a lot of times people will look at that and they're like, they don't see the big picture, right? It's like instead of buying that $150,000 house, you're better off buying, even though it may show as cash flowing positively 300, 400, $500 a month, and then you get into it and you realize it doesn't cash flow at all, actually. Why not buy
Or the
the
roof needs to be
better?
redone, or
Oh, everything, the
until the
tenants leave.
windows, or until
We've done 6 or 8 episodes just on some sort of that. So I love that you say that, because the $1.5 million asset versus the much less one. And I've seen it firsthand, is that I've got, 6, 8, 10 properties that I bought them for 25 to 60 grand, and they provide me essentially peanuts in terms of any kind of tax benefits. But at the time, I thought it was really smart, and I was getting this great ratio of purchase price to rent. And now looking back, I'm the big dummy versus the guy that just went out on the MLS and bought a $250,000 house that cash flowed negative $200. And then all the tax benefits that person is going to get, plus the nicer neighborhood, the nicer tenant. So I just want people to listening, don't make those same mistakes, because when people say, well, I'm buying it for tax purposes, no one really knows what the hell that means. They're just like, they're buying it for tax purposes, right? It's a tax write-off, right? And then they don't ask any more questions on it. So hopefully this helped to provide people with a little bit better understanding of what that means, and why buying why Clark's $50,000 great deal in 2016 that cash flowed $400 a month isn't such a great deal.
Certainly not for tax benefits, right? That might, there might be other benefits of that, right?
There's
Of
not.
that house for you. I don't know, but
There's
I will
not,
tell you,
Marcus.
if you're talking about tax benefit, it is not going to be one that's going to help you out too much there.
I'm just going to fast forward to the end of that story. There's no benefits, and how can I trade out of that stuff into the good stuff?
There you go.
Yeah, I think the takeaway right there for the listeners is, if you're going to invest in real estate, invest in high quality, A-class, big dollar real estate that actually does something, so you can take advantage of bonus depreciation, cost segregation, and the 1031 exchange. You can't take advantage of all of these tax benefits if your property is sitting in a swamp, not going anywhere, doing anything. I've got one question that I've been asked a lot over the years, Marcus, and we'll close out with this one is, I have a lot of very highly paid W-2 earners that I talk to that have a spouse. And that spouse is, built up a couple of rentals, maybe 5 or 6, 7 rentals, and they're just kind of bumping up against that, real estate professional status. Okay. And so you've got your, your well-paid W-2 earner, and you've got your real estate professional, and they file taxes jointly and together. Is that a strategy? How is that W-2 income treated when it's filed in conjunction with a real estate professional? Is there an advantage, disadvantage? Walk me through how the IRS sees that joined up income strategy.
Yeah. So, we see this a lot, and we do get people, and it's one of the strategies that we look at is the spouse as a real estate professional, right? Especially if the spouse is a low income earner or a no income earner, right? So, and the reason why I say low income earners, because if you can shift your spouse a lot of times into a real estate professional, the tax savings alone could make up for whatever their whatever you lost in their low income. So,
Yep.
if you're $1 million earner, let's just say you may be able to retire your spouse by simply having them focus on real estate, having them help you obtain real estate, working, it doesn't mean you guys can't work together to build the real estate portfolio, but they're going to be the focus. They're going to be the ones that need to get the hours, they need to do the 750, spend over half their working time. And then what's really, really cool about that is, let's say, you got that $1 million income. Well, half of that's taxed at the 42% tax rate if you include state. Then you've got your spouse that's coming in and maybe they can create you $200, $250, $300,000 worth of deductions. Well, they can pay for themselves being a real estate professional, and they're building a wealth, a long-term wealth package for you instead of just today, but the tax savings today could allow you to do that, right? So we see that a lot. We see it a lot with spouses that don't need to work, right? And the income is not necessary, but they want to, right? You do actually have to work. This is the one thing that I want to stress in that conversation is the spouse needs to be able to come in and want to do real estate, look at real estate deals, spend time doing real estate deals. The last thing we want to do is try and fudge how things are going, right? So the spouse needs to be a part of it and be a big part of it, needs to qualify. And then if you do that, it's kind of gangbusters, right? You can really do some awesome things.
It's why I asked the question, Marcus. It is just to reiterate on what I've just heard. You've got a very, very high paid W-2 earner, and you've got a spouse that's less so. You retire the spouse, buy some real estate, and get that spouse out swinging hammers and filing taxes and having real estate conversations and sourcing deals and doing a podcast, right? And so that spouse is out there now doing, their 750 hours a year of real estate. Now that spouse is, buying some assets over the years, and those assets, using cost segregation, bonus depreciation, and these other write-offs that you talked about, can almost pay and clear out a lot of the taxes that would have been paid on that high W-2 income. Therefore, that lower paid spouse becomes essentially a very well-paid spouse when you look at that holistically and as you look at the whole ball of wax. And I see an awful lot of people doing that. And that is the takeaway from this episode, as far as I'm concerned, is, I have many of my friends, colleagues, and people I know who I've had this conversation with, and they've gone from low paid or no paid jobs, and they proclaim themselves real estate professionals by simply buying assets, working in them, and virtually eliminating their W-2 tax burden. So that's just super beneficial. So again, Marcus, I'm going to ask you again one last time, how do people reach out with you? Thanks so much for this, by the way. Thanks for joining us. But how do people going to find you? How are they going to reach out to you? How are they going to get you?
Absolutely. I want to give you one more last piece of value, if that's cool, before
we take value all day.
Well, let's do it. So one thing I want your listeners, we're not going to get deep into it, but what I want your listeners to look at, if they are passive investors and they just can't figure out how to become active and they really want to get into real estate, I want you to look up the short-term rental loophole. Short-term rentals, you have a much easier ability to get considered active than as a long-term rental. And again, we don't have time on this podcast. Maybe David will invite me back for another one in the future. Look at that as an opportunity for a strategy, because you could potentially have some depreciation benefits by buying short-term rentals instead of long-term rentals. Again, might be a good place to start. Does that make sense?
Yeah. And that's for a W-2 earner can get these elevated tax discounts and tax treatment on short-term rentals that are not available for long-term rentals or any other activity. Is that correct?
That's correct. That's correct.
It
has to be done right. It has to be set up correctly, all the things, right? But just like, we talked about self-directed on the last podcast, set up correctly, done the right way, absolutely you have the ability to do it and take advantage of those losses.
There's some discounted Airbnbs coming on the market too. I think in this climate, there may be some
I would say
out
so.
there. So I'm glad you brought that up. But I want you to know, Marcus, that I've enjoyed, typically David and I kind of frame ourselves as a bit of the expert in the room on our episodes because we talk about things we're familiar with and on a higher level. Today, I have not been the professor at the front of the classroom. I've been on the 18th row raising my hand in the college classroom, asking lots and lots of questions. And I know a lot of people listening are probably that same person that kind of sleepwalk through their focus on deals, cash flow. They're not looking at the bigger picture. And you have just brought up so many good points to be able to kind of take that blindfold off and look around and start to see the light and say, wait a second, I am missing out on so many opportunities. And, working with a company like you and your team behind you is something that is almost essential, I think, if you really want to grow beyond having one or two rentals. It's not going to make a gigantic difference if you have one or two rentals, but when you want to start getting really, really serious in this and being able to maybe burn your boats and go full-time real estate investment, development, Airbnb buying, whatever that is, to me, it just sounds like a no-brainer that if it's not something you enjoy, which is certainly something I do not enjoy, but I understand how important it is, and these episodes have really helped to open my eyes. So with that, Marcus, I really appreciate it, and I've appreciated to have been a student on this episode.
Yeah, it's been great. It's been great. Yeah, I mean, I'll finish it off. If anybody wants to reach out to me, Facebook is a place where I'm pretty active on. And again, BECCFO.com, BECCFO.com. There's a little button at the top right that they can say, let's talk. And happy to chat. Even if you're somebody that doesn't think you'd be a good fit, but you need an accountant, we've got a whole process to help, try and steer you in the right direction if that's not the right fit.
Well, I'm going to close out with this, Marcus. My wife has never seen a piece of real estate in her life that she didn't want to buy. That's her. You know her. And it's almost exhausting being her husband in that respect. But she recently proposed quite a decent sized transaction to me. It was a lake house, it was a house on a lake, and there's a lot to that. There's just it's a different type of product that I'm used to interacting with, but she used that short-term rental depreciation strategy against me. Like, oh, I don't want to do it, da, 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 da. And she laid it all out. I shook, David, we're going to put this much down. We're going to get, the short-term rental depreciation and the bonus depreciation, the cost segregation. We're going to get all this done. And so whatever we put down, we're going to get as much, if not more, back in the form of taxes. And she's like, so, it's essentially not going to cost you at the end of the day anything. And I had to capitulate, and I'm now the proud owner of a lake house. And I'm pretty sure you sowed that. I'm pretty sure you're the one that put that worm into her brain.
Listen, I will not confirm nor deny.
Well, listen, Marcus, thank you so much. You've been a big impact in my life, and continue to be. And I think I want to just leave it with this. Clark just said something, and I couldn't agree with him more. If you are taking entrepreneurial life seriously, and you want to get out of working for the IRS from January until probably early April every year, because so many entrepreneurs sleepwalk into a tax crisis every year where they just haven't been prepping. They haven't been thinking. We use the term an ounce of prevention. If you haven't been implementing a thoughtful approach, you're going to sleepwalk into these things, particularly as you become more successful. That's the irony. You're going to hit this ceiling, that it's going to come up and it's going to smack you in the face. Before you get to smack in the face, reach out to Marcus. Reach out to BEC Group. And from there on out, Marcus, thank you so much for joining us. You've been a great guest, and thank you for your time.
Appreciate you guys.
Thanks, Marcus. See you, buddy.
Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. So don't miss the show. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats podcast on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you for listening.